Okay guys, we are looking at the intraday trading plan module for the trading plan development series. This is part 7, last in the series. All right, we're looking at pretty much a very generic approach to how I trade. Obviously you could build upon this. It's simply just an idea to use as a foundation for your demo trading, and the premise behind this style of trading is obviously still within the scope of trading in sync with the market structure. Okay. The duration of these types of trades obviously are intraday, and a portion of which, after being scaled out, may be held overnight. And if you use the previous modules also, we can use these concepts as well as entering into higher time frame trades as well. The average pip return is anywhere between 20 to 100 pips per trade. And if you look at the overall approach, when we look for buy signals, we're trying to trade in the observance of a bullish market maker profile or fractal, and we're going to be looking for price patterns and confluences around support levels, and the optimal trade entry is going to be utilized for entry price and fib extensions for profits. The entry and exits are simply based on time and price theory, and we'll talk more about that as we go through. And much like everything I teach, the opposite is said for the sell signals. We're going to be trying to trade in the observance of a bearish market maker profile or fractal. We're going to look for price patterns and confluences around resistance levels, and we utilizing the optimal trade entry for entry price and using fib extensions for profits. And our entry and exits are based on time and price theory as well. We're risking no more than 2% maximum per trade, and we're going to be utilizing risk management and control procedures as we discussed in how to handle losses trading module. And I'll have links at the end of this video so you guys can utilize those for amplified education if this is the first time you've seen my work. All right, looking at the overall concepts. Okay, the key points and concepts and tools we're going to utilize for this module is obviously hinging upon your understanding of price action. Now, do not be intimidated if this goes over your head the first time you see it. It's for folks that are basically students of the work I've already produced and shared for over the last few years on babypips.com in their forums. If you do not have the foundational information that's found in my thread on Newbie Island titled What Every New and or Aspiring Forex Trader Still Wants to Know, the first post of that thread has the framework for most of what you're seeing in this module. By utilizing those tools and spending some time with it and studying price action and not indicators, you'll build a backbone to flesh out the rest of your price action trading. Now, obviously, the next stage when we're going to be using intraday trading, your understanding of the Asian range. Okay, the Asian range was introduced to me by Chris Laurie. He's one of the well-respected individuals in the Forex industry. He's the only one that really I support in terms of teaching. A lot of the things he goes along with in terms of technical analysis and approaches to trading are very close to what I do. It's not exactly the same, but it's close as there probably is out there. Even though he is a paid educator, he does have free resources and information that's made available. At the time of this recording, you can reach him at chrislaurie.com. He has Twitter accounts and all that stuff, just like I do. The main premise to my intraday trading is based on the direction of the day and also trading in the direction of the week. Okay, so if I can trade in the higher time frame direction and have the daily bias in that same directional sense, my odds of success are greatly amplified. Okay, and as a day trader, when I used to trade the futures market, I used to trade the bonds in the S&P 500 back when it was $500 per point or full handle. I understood the premise of having the first hour's range. okay, and I use that as like the same thing that we're going to be discussing here for the Asian range, okay. And when I went into trading Forex, okay, I stopped trading the futures markets. I moved into trading Forex, and I had that same first hour premise going in, and I used the midnight time frame for me, okay, which is 5 GMT or New York time midnight, and I would bracket that 12 to 1 o'clock in the morning time frame, and I would look for breaks above or breaks below this particular range. Now, obviously, I'm not going to teach that here because now the concepts that I use with trading with the Asian range, obviously, like I said before, I learned from Chris Laurie. Um, I didn't know anything about the Asian range in terms of Forex until I came across his material. So um, all the credit that's associated with me and my Asian range concepts really should be attributed to Chris Laurie because that's where I got it from. I'm not one to try to take credit for something that I didn't either discover or come across on my own. So again, because of that type of trader I am, I like to give credit where credit's due, and the Bible teaches that. So I'm patterning my life after that as well. So looking at how the Asian range, and the Asian range is the price action that takes place from 0 GMT to 5 GMT. So that 5 hour window, that to me is my Asian range. Okay. And I use midnight New York time as my new day. Okay. I know that may be confusing to some of you because it's been talked about. Various mentors, various teachers, resources will talk about you know, Wellington and Australia and all that being the new financial day, not for ICT. Okay, I'm an East Coast trader on the North American continent. So to me, the new day for me is midnight. So I reference everything on midnight, okay, my time. But I also reference the previous price action, okay? That means from 0, 100 to 5 GMT, that price action still has to be utilized in your analysis, that being the Asian session. So the range that it creates, now granted, Asia still trades beyond 5 GMT or midnight my time, but I'm only concerned about what it has done up to that point. Now, Chris Laurie uh, is he revealed in his webinar we did together earlier in the year, he uses 5:30 GMT, which would be equivalent to 12:30 GMT. It's not so much that you have to be worried about that. You could use either one really, but I stick to midnight time or 5 GMT, and the range that price builds between those two windows of 0 GMT to 5 GMT, that to me, okay, is the accumulation stage for the daily range. Okay, in other words, the market makers are preparing, okay, to see the market trade up or down based on the orders that come in and start stacking up. Yeah, there's all kinds of orders that are placed that are pending, okay, on an institutional level, not so much the retail, because the retail traders, you don't really have the exposure to this type of information, but I promise you there's there's a lot of orders that are stacking up in Asia, okay? And as we get closer to Frankfurt and London Open, the volatility, the liquidity, the interest, the action, all those things start to build up, and you actually have the biggest point of volume for the day coming in around 2 a.m. or 3 a.m. New York time, okay, which would be 7 to 8 GMT on the average. Now, this range that's assumed by studying the high and low that's formed between 0, 100 GMT and 5 GMT, there's going to be initial stops and limit orders beyond those specific points. And we're going to talk more about that when we get into it. But based on where we go from there, okay, is how I arrive at my London Open trades. Okay, now I'll have a built-in premise before all these trades take place. I'm not just looking at a chart and saying, okay, well now it's doing this, I'm going to react. No, I've built a model and we're going to talk about that in here, and how you can utilize these concepts to flesh out your own approach to trading this specific time frame or time session in intraday. Because I do believe that if you are capable of trading this time frame or this session, speaking of which London is what I'm referring to, I think this offers the highest in terms of probability for maximum pip hauls for the intraday trading. I think even though it's probably scary to most individuals, I think it is the safest one if you understand price action, because it's very forgiving if you understand what you're looking for, and the the risk to reward is, to me, in my opinion, is optimal, because you're going to have risk in every session you trade, any type of trading. Okay, but for me, since I use a standard 30 pip stop, that's based on the premise that the average daily range across the board on the majors is about 100 pips per day. Now, obviously, it'll fluctuate up and down, but generally, 100 pips is pretty much a safe bet that that's the average daily range. So I'm using essentially a third of the average daily range for a stop. So if I'm trading with the premise that I'm trying to catch the high of the day, if I'm wrong, I'm going to really know I'm wrong. Okay, so 30 pips is going to permit me to do that. And we'll talk more about that as we go. But the London session, what specifically do we need to know about this session? What sets it apart from the others? Okay, well, typically it'll post the daily high or low inside of the first 4 hours of trading. If you just note on your chart exactly 8 GMT, 8 GMT, which is standard London Open time frame, you'll see that that many times makes the high or low, because it's the actual London Open, or what is referred to as the London Open. There's no specific exchange that opens up. It's just that's when everybody dog piles in and the order starts stacking up around that time. So by having this premise built in, if you have a higher time frame directional bias, in other words, if you expect the weekly range to be an up candle, okay, in other words, if you look at a weekly chart and the candle that you expect to form this week, starting on Sunday's trading, if you expect to see the candle for the weekly range to be an up candle, okay, or Friday's close to be greater than Sunday's opening, okay, essentially is what we're talking about here. Inside of that weekly range, you're expecting to capitalize on some kind of a bullish move. Okay, so by having that premise going into trading, okay, you're going to be looking for the low to form within the first 4 hours of trading during the London Open session. Okay, so in other words, you're going to be looking as early as 1 a.m. Eastern Standard Time, New York time, okay, or 6 GMT. Generally, 7 to 8 GMT is about when it starts to form, but the ideal bracketed kill zone that I like to call is 7 to 9 GMT. Okay, and you can learn more about these specific times and how to map out your charts. And I'm not going to do it in this session because I've done it extensively in other modules. But if you look at my video, how to trade the key swing points video, it actually shows you how to map out the London Open kill zone and the New York Open kill zone. So I advise you to take a look at that. So if you haven't, obviously this is a prerequisite for you to continue. So I would actually tell you to stop the video here and go check that video out, and then come back and pick up where we're at right now. Okay, so those that did take the instructions, welcome back, and those that didn't, shame on you. London Open typically sees a stop raid or false breakout. Okay, there's always this tendency for uh, London to see this initial rally up, fake, and then drops going into London close. Okay, especially if you're expecting a bearish move for the week or expecting a bearish day, you see this happen over and over and over again. The Asian range high gets taken out, or we break out of the Asian range, trade right back into the Asian range again, create an optimal trade entry, sell off, and then goes down into New York and or London close. That's generally the type of style of trading that I do in the London session. Now, the swing that takes place from London going into a later part of the day, I dubbed the London Express, and it simply means that I look at it like a train ride. It takes 4 to 8 hours in duration. Okay, and if you get in the right direction, it can really take you places, guys. It has a huge amount of pips laid at your feet if you understand what you're doing and you don't fear holding all day. If you're a scalper and you get in here and you do these 5, 10, 15-minute trades and you think you've made a lot of money, that may feel good, okay, but don't live there. You should develop a little bit more in terms of price action and understanding, and allow your, especially if you trade in London, permit yourself to hold something throughout the day. Okay, if you do that, you'll have a whole lot more pips laid at your feet versus just going in the market and taking a few pips and being happy with that. Additional trade entries can be made in the direction of London Express trends, and you can do that by trading at the New York Open. Now, it's not my point to teach the New York Open. We do have a webinar that actually was recorded, Trade in New York session. You can find that on my YouTube channel, and it's also linked on Baby Pips thread, what every new and or aspiring Forex trader still wants to know. On the first page of that thread, my first post, the opening title post, it has an index of all my videos that's on YouTube, my initial Forex trading course. All those videos are there. That webinar is in that list as well. Time objectives are utilized for profit taking, and those being 1500 to 1600 GMT. You've seen this many times in my videos, many times calling the actual high or low of the day. If we do hold on to a portion of it, we look to try to take some out at 1800 GMT if it continues to move on from the London high or low that were traded. And then if we have obviously a small portion of the trade on to hold overnight for additional profits that may ensue going into the next day's trading, obviously we'll talk about that when we get to it. But we take profit objectives based around time and price theory. Okay, and it means support and resistance, swings, projections, Fibonacci's, old highs and lows, and specific times. That means the New York Open. Again, look at the Trading to Keep Swing Points video module on the information around the New York Open. Then the 15 to 1600 GMT, the profit taking hour, that's the London close. We like to take our largest portion of our intraday trading profits there. And then obviously if we're holding intraday and starts to run, we can get a late New York swing going into 1800 GMT. But if you're specifically going to be looking to capture only intraday action and never hold overnight, take the lion's portion of your profits around the 1500 to 1600 GMT hour. So inside of that window of 1 hour, look to take your profits and scale out the largest portion. If you're going to hold a little bit, okay, obviously tighten your stop loss up and then reach no more than 1800 GMT if you're just an intraday trader not holding overnight. But 80% of the time, you're going to see that 1500 to 1600 hour post the counter high or low. In other words, if it's been a down day, you'll see the low form around 15 to 1600 GMT, and if it's an up day, you'll see the high form for the day around 15 to 1600 GMT. Okay, so London Open gives you the high or low, and then 1500 to 1600 gives you the opposite end of the daily range. Okay, so if you take nothing else from this this video module, that right there in itself will make you more money in your demo account than you've ever probably imagined. Okay, that's how precise these concepts work. Now, when you start adding all these other components to it, it's like voodoo. Okay, it's just amazing how this stuff works out, and you'll be pleasantly surprised once you start applying these concepts. Now, when trading in the anticipated weekly trend direction, you want to take some profits intraday, but do not trail your stop loss too aggressively, because if you do that, just in the New York session alone, you'll see many times there's a deep retracement going into the swing that ensued in London Open, only to give another additional selling opportunity to go into London close. So you're going to need to learn to trust the fact that price is going up and down, and a natural ebb and flow of price action, it still will slide in the home around London close if there's not a market reversal profile, and we'll talk about that later on. But allowing the market room to move and not trail your stop loss so aggressively, this will permit your positions to remain open and not get stopped out prematurely without seeing your maximum price objectives fulfilled. All right, we've talked about the market maker profile. Okay, this is the ICT market maker profile buy model. And by looking at this, okay, we've discussed how there's an accumulation phase in here, and then price starts to break out, comes back up many times and retests. It doesn't have to do that, but it can give you another additional optimal trade entry short in here, or a reflection pattern, and then sells off, goes down, makes a low, okay, and then reverses and gives you a breakout, maybe a retest or an optimal trade entry in here to get in sync with that move. once market structure is broken to the upside, and then you have another additional, sometimes secondary position to get long, and then you're going to reach back for this previous consolidation where stops would be resting prior to these highs in here, and you see that unfolding. This premise or understanding of how price swings, in other words, it's engineered to go lower to go higher. Okay, if you are an intraday trader, this same premise to price action study repeats itself on an intraday scale. Okay, we've looked at higher time frame models of this price action, okay, or this fractal pattern, but it also repeats itself on intraday price action. Okay, and those that have been students of my work for the last few years on baby pips should recognize that this is very similar to my classic buy day for the London Open. Now, initially I did a London Open video module. It was very, very brief. It had zero audio in it because I was really, I'll be honest with you, I was reluctant in releasing some of this material until there was a lot more structure and education behind it all, because I would have never been able to keep up with the level of emails and questions of what does this mean, what does that mean. So now I think that I have a lot of my foundational information presented already and available, widely available on YouTube and Baby Pips. There's many resources you can go to further educate yourself on what I'm referring to in this video module. Okay, so I knew doing it the first time it probably was going to be not as effective as I was hoped it would be, but I think this time around those that have seen the first one will agree that this is probably a far better approach to teaching the London Open session with my tools. And obviously looking at the ICT sell model for the market maker profile, when we see price run up like this is a rally. Okay, in other words, they engineer price up and then it trades lower. So in other words, they make it go up to go lower. Okay, so there's a accumulation. Okay, there is a rapid price increase. Okay, and then you see a sell-off, and it goes back to the previous consolidation and or below it. So let's take a look at what this looks like with price structure. Okay, now if we're going to be an intraday trader, and this charts are similar to the previous video module, okay, but it will allow me to teach the same premise, because price action is price action. It doesn't matter if you're looking at a 1-minute chart, 15-minute chart, daily, weekly, monthly, it doesn't matter. The same concepts hold true. There's going to be some things that we talk about in this video module that is generically inherent with intraday trading because of the nature of that type of trading, but by far and large, most of everything you're seeing here is just a compilation of all the things on the higher time frame applied to the smaller time frame. Let's assume we have this price structure here, and this may be a daily chart or it could be a 4-hour chart. Okay, but really for day trading purposes, if you focus in on the daily, 4-hour and 1-hour, that's your universe for your foundational premise behind your directional bias. Okay, everybody sends me emails, they talk about on the forums all the time, you know, this is great, Michael, I see your videos, this is absolutely phenomenal, the tools work so wonderful on the left side of my chart. I've just been exposed to your work and it's great, but here's the problem I'm having. I'm looking at the chart on the hard right edge of my screen and I don't know where it's going to go from there. So you have to look on the left side of your chart, guys. It sounds counterproductive, okay, because you're looking at what's already happened, but that tells you where price is trying to go. Okay, we've seen price obviously trade lower, okay, and the market structure breaks in here. Okay, once the price starts to retrace in here and rallies up, we have now a possible swing low forming. Okay, this is a daily chart, or if you have an intermediate term low, if this is a 4-hour chart. Okay, or it could be even a long-term low. Okay, doesn't matter, just understanding where we are in terms of price action. So if we see this example, let's say we're looking at a 4-hour chart. Okay, maybe this is a 4-hour zoomed in and we've came down on a daily into a higher level support line. Okay, so this may be a big figure, or it could be a mid figure, it could be a whole list of things. Okay, a monthly high now traded back down to a support, but price comes down to it, and simply because it trades to it, there's two ways of doing that. If this is a higher time frame resistance and support level, okay, and we're expecting price to provide support here, we don't always just assume just buying it because it gets to a level like that. You can. There's nothing wrong with that. It takes a lot of guts. But if you're willing to wait for price to give you clues, it may have in fact assumed longs in here by the smart money. We wait for the market structure to break, and you see that by a swing high being broken here. Okay, so if you see a 4-hour break in market structure and then you see the price retrace back down, you would expect to see it not go back down below this low. So you would see an optimal trade entry in here. So now obviously you would expect to see what to unfold? Higher prices. Okay, so from this point on, what you're watching is you're watching market structure. Okay, you're watching how market structure unfolds, the swings, all these types of things that we've looked at in the higher time frame, just simply utilized here as well for our intraday daily premise. Okay, now by looking at price like that, okay, what we're going to be doing is we're going to be expecting and anticipating highs and lows to be forming. Okay, when this market structure break here happens and we have a shift in market structure to bullishness, okay, again, assuming this is a nice support level, price comes down, gives us an optimal trade entry. This low that forms the optimal trade entry in this little swing down, this could be the new day here. Okay, this could be the start of the new right there, could be the new day. And then we had this move lower that you understand as my Judas swing. When it dips down from that, initially, that's the move that you buy in London Open. And you expect the daily range to fulfill going to the upside. Okay, same thing happens here. If we've seen price drop down lower in here, this could be a New York Open market reversal and trade lower, and then this could be a new day here, or it could be a new day right in here where we have the Asian range, and then there's a dip down, initial drop or Judas rally, I'm sorry, decline, setting up a buying opportunity, and we'll talk about that as we go. But you want to be looking for opportunities to get in sync, okay, getting sync with this market structure that's bullish. Now when we have these very clean discernible price legs like this, or price swings, this is an impulse move. Okay, when you see price run up like this, okay, you're going to be expecting a retracement at some point. And when you start to see that unfold, you want to pull your fib from the low to the high and look for these obvious levels of retracements. Okay, now you can be a day trader, okay, with market structure corrections, okay, and retracements, and be shorter, shorting in here and in here, but never losing sight of we're possibly just retracing deeper with this higher time frame 4-hour market structure, or it could be a daily market structure we're looking at here. So by having the higher time frame daily, 4-hour and 1-hour charts up and mapping out price swings and where we are in possible levels of retracement using your fibs, this level could be an optimal trade entry buy based on this low to high, could be a 62% retracement level, or if you use this low here on market structure to this high, this could be a 62 or even a sweet spot or 79% retracement level. Okay, so when we get to these levels, it could be starting to trade here in midnight time in New York, and then you had that swing lower into Judas, okay, and it comes right down, blows out an old low, comes down and maybe even finds support like we would see here. And then this is your London Open buy to get in sync with that higher time frame premise, and you would let your profits run going towards higher prices going into New York Open and London close, and respectively. Maybe if you're going to hold it overnight, this is why you would do it. Okay, maybe not so much holding a long in here overnight because you're expecting a deeper retracement, but all the things we learned in the higher time frame and market structure and other videos, all those things culminate with intraday price action and utilizing these higher time frame premises in intraday action. Now, the easiest, most sweetest setups come when you trade between intermediate term and higher time frame long-term price swings, and those being the blue circles here. Okay, and we've talked about this in the previous video module, so I'm not going to go over what these are. Do some study, guys. Go in and research this, okay? But the intermediate term lows in here, if we trade off of the intermediate term low and get long only, trading London Open longs, expecting Judas swings lower, okay? Trading becomes absolutely easy. You know what you're looking for. you know your overall premise is to be expecting bullish prices. Okay, so now what do? We apply the concepts that we learned in how to capture explosive price moves in the Forex market video module, where I teach that between Sunday's opening and Tuesday's London Open, there's a high probability of the weekly high or low to form by Tuesday's London Open. Okay, if it doesn't form by Tuesday's London Open, generally between Tuesday and Wednesday's London Open, the weekly range high or low will establish itself. Okay, so now think about this. Let's assume for a moment we've mapped out this is a higher time frame support level. We had market structure shift here. Price comes down, the optimal trade entry. We're in a bullish leg. Okay, every time price comes down, we're still expecting price to provide us a buying opportunity. Okay, now what are we looking for going up? Well, obviously we have this price leg here from this high down to this low to contend with. This is the range that we're trading within. Okay, so you have to have your fibs pulled up, and this is going to be your 79 or 62 or even sweet spot based on the swing from here to here. But also notice there's a smaller wave in price action from here to here. So you have your range from this high down to this low. So when price gets up to around that 62 to 79% tracing level in here, that may be a reason to be more cautious taking London Open buy signals. Okay, so using the inside the range concepts we learned earlier in the year in the webinar, okay, the same premise holds true here, that you still have to look at your previous price swings and how they map out. You can build your premise based on that. Just doing this alone will give you high odds probabilities to base your trading on. So now think about what we've done. We've established a premise to expect bullish prices based on the market shift and structure here. So when this move went above this previous swing high here and starts to retrace, gives an optimal trade entry and starts to trade higher, we have confirmation that we are in a bullish leg. Okay, now market structure is bullish. Okay, at this point here, market flow on all time frames probably will be going going up. So it makes trading easy. Now you just simply wait for the setups to unfold in London Open, and if you're a New York Open trader, I'll toss this in. Just wait for your buy signals in there as well. Okay. But looking at how price trades at the London Open, we would expect to see price drop down, okay, out of the Asian range, or if it breaks out initially, if it trades back down into the Asian range, look to trade optimal trade entries while it's inside of the Asian range. And we'll look more about that when we have the actual diagrams and such. But if we are trading with that premise that it's bullish and it's Sunday, what's your homework? Hopefully, leading you to that we're probably going to see the low of the week form by Tuesday. Okay, so if you're really capable of trading the London Open and you can sit down and be a part of Monday's London Open or Tuesday's London Open, if you have that capabilities to do that time-wise and it fits your lifestyle, many times you can actually end up buying the low of the week. And I can tell you that's absolutely mind-blowing when you look at how many times it can be done. And even if you get a small portion of the weekly range, okay, if the average daily range is 100 pips, the weekly average range could be several hundred pips. So if you get a small portion of that, you can look at anywhere between 150 to 300 pips, as a potential pip haul. So even though we're supposed, specifically talking about day trading here, I want you to use these concepts to kind of broaden your perspective and say, hey, I can use these concepts really to get in sync with these higher time frame trades and not, exit the trades too prematurely and allow my, trades to pay me more. All right, so now thinking with this premise in mind, if we're bullish, okay, this could be a 1 hour chart, okay? We're looking at a possible bullish move going higher. We see price trading lower, okay? Now, if the previous chart shows that market structure shift bullishness, if we zoom down to a 1 hour chart, we can actually start seeing smaller swing highs, okay, that would assume that we have this higher time frame support level. If that market structure breaks here on an hourly basis on a smaller short term, we can start seeing more time sensitive price swings. Okay, and price is still going to swing, based on price action. Okay, you're not going to change where it's going to go, but your perspective on looking at it, okay, can be really skewed based on the time frame you're looking at. So if we're looking at just simply this high to this low, this could have been lull you into believing this could be a sell-off, okay, or optimal trade actually sell. But having that higher time frame premise in mind, and this being a higher level key support level, okay, that we talked about earlier, the premise is that we're expecting market structure to shift to bullishness. Okay, so every time we see a retracement, all that's going to do is likely set up a new buying opportunity. So every time price creates a new range, we just run our fib from that and look for the 62 to 79 retracement level optimal trade entries. Okay, obviously you would be looking for reflections as well. This could be a reflection. This low in here down to this low here could present a optimal trade entry, yes, here, but it could also be a reflection as well. So don't just think in terms of you always have to have the optimal trade entry. It's the easiest one I teach, but other patterns, like you could have ICT Grail in here, a type 2 trend following. It could be a stinger in here. Okay, all these types of patterns. Now, if you have this higher time frame premise in mind, you start looking for these patterns to unfold with that directional premise. Okay, so by having that unfold on an hourly basis and having your dynamic support and resistance levels carried from the higher time frame down to these shorter time frames, you can expect more clear price swings based on the hourly chart. Your weekly management of price swings intra-week should be focused on the 1 hour time frame. So once you arrive based on the daily and 4 hour charts, you can really work the rest of the week off of an hourly chart, just using support and resistance off that, measuring swings, using your fibs. But when you enter the trades, when you take action and you're actually part of the trades, you manage those trades on a 15-minute time frame. Okay, so have that in your notes. I know you're probably saying, why didn't you give me a screenshot with all this stuff written down? It's so much easier just to cut and paste. No, keep yourself a log, keep yourself a journal, make your own notes. Okay, if you write it down, you have a more higher chance of remembering it versus me just talking about it. Okay, so again, you're looking at the daily and 4 hour, looking for market structure to break, give you a higher time frame directional premise. Where's price trying to reach? Okay, then once you have a market structure break, okay, it makes the trading very easy for you in terms of directional premise, because that's the direction you're going to look to trade in, okay, based on the daily and or 4 hour. The 4 hour is going to be much more sensitive, so if you have a little bit firmer understanding of price action, you could probably just live on the 4 hour. But also make sure that you don't forget there's probably daily support and resistance and weekly support and resistance and monthly even support and resistance that may be a factor that you still have to contend with. So we're not negating the benefit of having a higher time frame top-down analysis, but if you're just starting off and you just want to get in here and start chasing action, this is obviously how you can do it, the daily and 4 hour. But once you have your directional premise based on those higher time frames, you live on the daily chart. I'm sorry, the 60-minute chart for your intra-week swings. Just watching the 1 hour chart and then watch how price swings within that time frame. But if you enter the trades, you manage them on a 15-minute time frame. Okay, you manage the trade on a 15-minute chart. And that's because if you are at some point going to move your stop loss and trail it, you want to be using the previous two swing lows prior to where price is trading at now. For instance, say we're here and we saw price run up and we blew out these highs and we're long. Here's a swing low and here's a swing low, and assuming this is a 15-minute chart now. Now, I know I may probably be confusing you talking about different time frames, but just go back over the video, just rewind it, okay? But this low and this low here is two swing lows prior to current price action. So assuming price is trading here, breaking out above these highs here, and we're long something back here or even here, this swing low and this swing low are the last two swing lows that most recently formed. My trailing stop loss will be 10 pips below this low here. Okay, so in other words, I'm managing my long with a stop 10 pips below the second most recent swing low. Okay, and obviously just reversing it, assuming that we got short back in here. Okay, and price is now breaking down here below this low. This is one swing low and this swing low here. Now the caveat is you got to have a higher swing low than the first one. So this one would not be considered. This swing high and this swing high. This is your second one back. So in other words, as price is moving in your favor, on a 15-minute time frame, I would look for the most recent swing high on a 15-minute basis if I'm short, and then go back and find the higher swing high than that on a 15-minute basis, and I would trail my stop loss 15 pips. I'm sorry, 10 pips above that. Okay, so my stop would be above here, and I would continue to do that as price trades lower. Okay, so in this case, once we break this low here, trading right into that support, this would be the swing high, and then the previous swing high. So this is the most recent swing high at this point here. So I'll be 10 pips above this. You can see, even though this is a crude diagram and drawing, check out price action on some of the moves that's recently happened, and use a 15-minute time frame, and you'll see that many times it keeps you in the trade. So that's how we break our charts down. That's the time frame usage and utilization, how we look from the higher time frame down to the lower time frame, and we would look for the 1 hour chart to create its own support and resistance as well. Okay, and then obviously looking for upside objectives based on swings on the 1 hour chart and 15-minute chart. Okay, so running your fibs on these swings here for getting extensions and fib expansions will serve you well. Okay, we are looking at what you see typically unfold in London Open. All right, we're looking at a price move here. Okay, we have an Asian range, and we'll see typically a initial pop up out of the Asian range as a fake out. This is when they tag the pending orders for those that may be short. They'll tag those individuals out, and those that want to be long on a breakout system, okay, they'll run the market up there and trip those individuals into the market, because that will create a pocket of liquidity. Okay, the dealers will take it up there, they'll fill it, okay, and then they'll trade it lower. Okay, this is the engineered price decline. Okay, now think, what was going on over here? Price has been rallying. Okay, if we're in a bullish market structure, okay, don't think just simply because we're falling out of bed in London Open's early session, that's not going to always equate to it's going straight to Hades. Think about it. Price action, when it's going lower, okay, it's going to go lower to make a low and then trade higher. Okay, so this is the price engineering that takes place over here. This low back here may be a previous day's low, it could be a previous week's low, it could be a higher time frame support resistance level, it could be a Trinity level, it could be pivots, it could be a whole list of things that cause the price action to rally up from that point. But you would run your fib from this point here to the highest high, either inside of this day or whatever high it's formed here, and you would pull that fib here, and then you would look for optimal trade entry to pull back into as the Judas swing breaks down. That's how you time your London Open buys, assuming you have a bullish market structure and everything is expected to go higher. This level here needs to have something associated with it. Okay, in other words, when you see the fib from the low to here, in other words, this price swing up here, we're trading inside the range. Okay, so as price starts to retrace, we're trading within the discernible range, that low to high, or whatever higher high is over here. In this example, the previous high is this, is a little bit slightly lower, and then it starts to trade down. This is the Judas swing. Okay, in other words, price is trading lower. Okay, now when you see that happening in London Open, and you're part of like chat rooms or forums, you'll see those that are brave, they'll come out and say that I'm short, and assuming this is the cable British pound USD pair, they'll come on board and say, yeah, I'm short now, and I'm selling, and I'm on 10 pips profit. I'm at 10, 12, 15 pips profit. It's going straight down. Yeehaw. Well, right around 2 to 3 o'clock in the morning New York time, what'll happen is the market participants that know what's going on, they understand key support and resistance levels, they understand price structure. Okay, there is a huge interest in buying this sensitive high level key support and resistance level. Okay, so when they take it down there's going to be a large entity that we call smart money that's going to come in here and accumulate all kinds of long positions here. So we're waiting for this to unfold. When price does this, okay, we buy right here. Okay, this is the optimal trade entry in London Open. Now you can look at a 1 hour chart and see this, okay, but predominantly it's a 15 and 5 minute chart that you'll see this type of action in. When it comes down to it and you see a 5 minute optimal trade entry at that level here, this is where you buy. Okay, now also when price is trading down here, you want to look at correlated pair SMT. You want to look at USDX SMT divergence. Gives some kind of framework to establish some confidence behind this level. Simply because we have a range here and it trades back down to that level and it's bullish, it could still go down a little bit lower than that and still, ultimately trade up or even continue going lower. That's why we use stop loss orders, because we don't know for certain our analysis is going to be fruitful. But this is how we would be buying the market in the London Open. And obviously as price starts to move up, we will be looking for the highs that's been established in the early London Open session to be tripped and taken out as upside objectives. Okay, that's assuming that we have a bullish market structure and higher prices are likely. All right, so let's look at that a little bit more closely. Okay, we have an Asian range here that unfolds, and we're assuming that we are in a bullish market structure. Okay, we're expecting higher prices. We're expecting the market to go lower to go higher. Okay, so in other words, it's going to trade down to a higher level, support level. Now this level down here may be, again, could be a previous day's low. It could be a previous day's high. It could be a previous day's New York session level. Okay, because New York was the most recent one outside of the Asian session. It could be a previous month's high, okay, or weekly high or low, something along on a higher time frame premise. Okay, there's going to be something that contributes to the fact that this is a low forming. But before the Asian range is broken, many times again we'll see that rally up. This is a turtle soup sell. Okay, and if you're a scalper, you could see this as an opportunity to scalp and go lower. I don't trade like that. Okay, once the Asian range low is taken out, many times you'll see it retrace and test that level again, and this could be your short. Okay, if you again are a scalper with the expectation to take profits down here at the higher time frame support level. Okay, but I am not that type of trader. This is the setup that I hunt. Okay, if I'm in a bullish market structure, I'm expecting higher prices. Okay, and I understand that looking at that previous slide we had, this decline was taking me inside the previous range. Okay, or that price swing that we just discussed. When we get down there and create an optimal trade engine here, that's where I'm buying. Okay, because we have a higher low here in this example. And if this is the cable on the fiber, this may have created a lower low here. Low in fiber. Okay, so you may not see the SMT divergence there, but you may end up seeing a higher high in the dollar. So you would end up with a USDX SMT divergence here to support the long on the cable. Obviously, when you see the market structure shift on the intraday basis, if you miss the optimal trade entry here, you could look for another opportunity to get long there before it starts to go off on a tear. And then obviously you would be looking for average daily range to fulfill. I do not consider average daily range. Now, average daily range is a tool that you can get off of most platforms. You just pull up the indicator and just look at what the average daily range is for the last 5 days is what I use predominantly. I'm not going to go into other ranges of average daily range. I use others, but most of my analysis is based on a 5-day average daily range. So I'll be utilizing the MT4 tool that I shared on the internet for my average daily range for a 5-day basis. I don't even load that up until I get to 10 GMT. Okay, so have that in your notes. At 10 GMT, that is when you open up your average daily range. Okay, and then whatever that level it shoots for a projected high, that's what you would be aiming for the day. Now, it doesn't always get to those levels. Okay, many times it'll probably fall short of it, and many times it'll go well beyond it. And we'll talk about that later on in the video. But unless average daily range has been fulfilled, if we get a retracement in the New York session, and by pulling your Fibonacci based on swings from the London Open session, we could get another optimal trade entry in here to get long and fulfill the rest of the day. So if you're a type of trader that wants to add to winning trades that are open, this is one way you could do it. Or you could take profits here, and then look to take another smaller position in here. Okay, I'm not advocating you should trade like that, but there's a lot of freedom involved by having this understanding, because you could apply it to whatever type of trader you are. If I went long down here, my stop loss would remain below the daily low. Okay, so that's one of the important things, that if you're a day trader and you're trading London, I do not trail my stop loss inside of the range. Once the lows formed in London, whatever these short-term lows are, I could care less. Okay, because I know that New York is likely to have a retracement, rather deep sometimes. So that's why I take some profits. When we trade back up and blow out the Asian range highs again, once we dip down, I'm taking sometimes 30%, 50% in most cases, and sometimes even 70% of my trade off at that level. Now, what establishes that parameter? Well, if I'm trading against the higher time frame premise, I'm taking 70% off here. Okay, if I'm trading with the higher premise in mind, I'm taking 30% off here and leaving 70% on, reaching for the average daily range or higher. Okay, if I'm just really not sure, I'm not comfortable, I'll take 50% off of the trade here and leave 50% of the initial entry on long, but my stop loss stays down here at break even. Once it goes inside this daily range, it should never come back down to that low again. If it does, the trade's no good. Now, if it does and takes me out, I could care less. Hopefully I've made first profit in here, or I've moved my stop up progressively enough to limit my risk. Even though my initial stop loss is 30, I'm at some point, as prices start to move here, I'm trimming it down to 20, 15, 10, 5 to break even eventually. Okay, but I'm not in a hurry to move my stop loss up to a break even. I'm not trying to lock in profits, because you'll learn by doing this over a period of time that price action intraday, many times they know how you're going to trade, and you're going to trail your stop loss in there. So if you're right on the day and they can tag you out and you're long, think about it. What's your stop loss going to be? It's a stop for selling. Okay, it's going to become a sell order at the market. Who's going to take the other side of that trade? Smart money. So if they can take it back down there and stop you out, and your stop becomes a market order to sell, that stop being triggered, your long gets sold to them, because they're going to buy it. Okay, and then they'll be on the move, going higher, going in the average daily range or London close up in here in terms of time and price theory. All right, now many times you'll see price give you this buying opportunity, and this may look a little bit different here, but what I'm going to bring to your attention is many times it'll trade up bullishly and you'll be long in the London Open. But if we trade up into a higher level key, or weekly or daily or even monthly resistance level up here, and it trades up into the New York or London close time frame, many times this will set up a market reversal profile. Okay, so have that in mind. Don't marry the vein simply because you have a bullish market structure and everything's bullish and you're being profitable. Don't hold on to these things thinking they're always going to go to the moon. Okay, because this is the scenario that may unfold, and if you hold on to your position with too much of the initial position open, you could end up seeing some of your profits actually erode and maybe even become a losing trade. And again, this illustrates the notion of why stops are important. Okay, obviously, if we're looking at the reverse, and we would see price rallying up here, and this is going to illustrate an hourly chart. We would be looking for the price swings on an hourly basis intra-week to permit our trading based on a daily and 4-hour premise or directional bias. Once the hourly chart gets in sync with that, it just makes your London Open trades very, very easy. And again, this is not to teach you how to trade every single London Open. It's just to mainly focus on the real easy setups. Okay, and by easy, I don't mean guaranteed profits. Okay, so everything I'm teaching you here is for you to utilize in a demo account. Okay, so you got to pay attention to these risk disclaimers in the beginning of the videos. They're there for a reason. They're not for decoration. Everything I'm showing you is obviously just for informational purposes, so utilize them in a demo account. I don't want credit for you making money, and I certainly don't want credit for you losing money, so you got to be responsible with this information. So with all that said, this being an hourly chart, we got to look at the swings on the hourly basis. And while this illustrates a rather crude example of price action, all the things that we said that were true about break in market structure going bullish, same thing happens here when market structure breaking down on this high here. Every rally up is going to be a possible area to look for selling scenarios in London Open. So looking at that, this is what you end up seeing many times. You'll see this swing down and there's a rally up in London Open. You'll get a optimal trade entry many times, trade up into this specific point here. Okay, but initially you'll see that Asian range in here. There's an initial drop down, pending orders that are tripped. Okay, those that are caught net sellers, okay, are dragged against the coals, and then all of a sudden, they go into a deeper range retracement here, optimal trade entry. Once you see this higher time frame resistance level, again, much in the same capacity we used for the buy scenario, the same rules apply here for the sell. You would look for the London Open kill zone in here, 2 o'clock in the morning, 3 o'clock in the morning, 4 o'clock in the morning, New York time, or 6 to 8 or 6 to 9 GMT. That window of opportunity for the London Open, that's the kill zone. You would look to see this actual high form, and this many times will be the actual high of the day, and then you would just wait for price to try to move into that New York Open time frame or London close. So looking at it a little bit more detail, again, much in the same way we did with the buy, we have the Asian range in here, the initial drop. This doesn't have to happen, but when price rallies up out of the Asian range, many times you'll see it dip back down into it, giving you a optimal trade entry here, and then rallies on up into a previous higher level support resistance level. Again, much in the same way we talked about for the buy scenario. This setup in here, okay, this setup in here is what you're hunting. You don't want to see this. This right here is the Judas. You anticipate this when the market structure is bearish, when you're expecting lower prices on a higher time frame. So this is how you fade rallies. You sell rallies. You hear that that market proverb, buy low, sell high, and then sell high and buy lower. Okay, well, selling rallies and buying dips, this is what we do. We expect this rally to take place. We don't chase it. Okay, if you're a scalper, sure, you can do that. I'm not a scalper. Okay, I'm teaching you how to intraday trade with the London Express. Okay, you're trying to be in here for an intraday run of several hours, not a couple minutes. But if you see the optimal trade entry in here form, okay, once the price starts to break down, it may give you another secondary optimal trade entry, and many times you'll see that unfold. But usually about this time, it's 10 GMT, and it's really on their way. Okay, and it'll rally back up into a deep retracement using a London Open high, short-term high. You can see that on a 5 or 15-minute time frame. That's where you'll get your optimal trade entry for a secondary entry or continuation pattern for the daily trend in the New York Open session. And then it'll reach for the average daily range down here, 5-day average daily range. So the initial rally, obviously, again, is assuming that we have a bearish market structure. Okay, the rally up is the Judas into a known key resistance level. Okay, now this level could be pivots with trinities. It could be a big figure. It could be a previous week's high or low. It could be any time frame support resistance. Okay, look at the trading key support and resistance levels video module. Okay, it gives you all kinds of ideas of what levels you should be paying attention to. This also, okay, and we talked about Asian range earlier. When I learned Chris Lurie's approach to applying the Asian range to Forex, I learned that if I used the previous week's Asian range for Friday, in other words, the previous week's Friday's Asian range, and the beginning of the week Asian range, Sunday and Monday, okay, those Asian ranges, extend those levels throughout the entire week, many times those levels act as support and resistance levels, and I don't know why, so don't ask me. I just noticed one of those little things in the marketplace. I'm not sure if Chris Lurie knows about it, but I apply it to not only my intraday. In other words, by having these Asian range highs and lows, okay, Lurie teaches to extend that throughout the entire day. Well, I took that premise and just said, okay, well, what happens if I take it and apply it across the week on key days, being the beginning and the ending of the week? And I'll let you decide whether or not there's any merit to it or not, because I think you're going to be smiling when you see what happens. It doesn't matter what pair. Okay, just look at the Asian range high and low on Monday and Sunday and on Friday, and extend those across the week. So you're using previous Friday and this week's Sunday and Monday's Asian range high and low. Okay, and many times I've used the previous week Sunday and Monday's Asian range high and low too to draw it across. But you'll be fascinated to see how that many times creates dynamic support and resistance levels. Again, I don't know why, but obviously there's a lot of dealing that goes on around those levels, and somebody in there is doing their business. But you'll be looking for, obviously, price trading lower, reaching for the average daily range. Again, not loading the average daily range indicator until 10 GMT, which is 5 a.m. my time on New York. Um, I live in Maryland, but I'm speaking in terms of New York, so you guys understand East Coast time. And basically, as we get short, we don't trail our stop loss inside of the daily range. We keep it at break even, and we take profits at logical areas of support and fib extensions. Okay, so um, by doing that, it's easy to absorb retracements on open portions of the initial trade, because you've already banked some profits. So even if it comes all the way back and takes us out break even, we've made money on the day. So that's what it gets to. You really want to see your trading get to the level of not feeling like you have to be right. And if the trades go against you, so what? Either didn't lose much, or you take first profit or a portion of your profits, and if it goes to break even, it's never really break even now, is it? You profited. All right, obviously, London open sell signals obviously could end up being just the catalyst for a market reversal profile. So if you see what looks like a classic sell-off, okay, many times it'll trade down into a higher time frame, monthly, weekly, or daily support level that you have to be mindful of, okay? Because this dip down here that you're trading intraday may be a part of a higher time frame price leg that's maybe over here, okay, and then trades down, and there's a higher level optimal trade entry buy scenario. Okay, so all these things have to be considered, and it goes along with what we've discovered in the Inside the Range webinar this year. And I know you probably heard me say this several times, but you can find it on the Millionaires Traders Guild thread on Baby Pips. It's in a thread in the beginning of the post, the very first post of that thread. You can see the link for that webinar. Again, it's Inside the Range. So those concepts of using Fibonacci and where price structure moves from one high to low to intermediate term high to low, and working within predetermined ranges will allow you to expect, or at least anticipate, these types of events. So while this may be a profitable London open sell scenario, don't be blind, okay, to this unfolding, and it could very easily sneak up on you if you're not looking at the higher time frame premise. All right, so when do you avoid the London Open? Okay, well, me specifically, I try to limit my London Open trading around a few obvious reasons. If interest rate announcements are coming out, obviously I'm on the sidelines waiting. And if there's a key speech, a keynote speaker, or a big deal, comes across the news wires that, hey, look, so and so is going to be talking about whatever, economy, and it has a direct impact to my specific pair, I won't trade. If it's a holiday, I won't trade. If it's approaching a holiday, many times I'll second guess trading. And if there's a global or economic event that takes place that surprises the markets, I won't trade that day, not even even New York. And obviously, if my weekly range objectives are achieved, there's no need for me to go in here and try to chase it. I'll just hopefully have a position that's open. And occasionally, if the Asian range is greater than 50 pips, I will just wait for the New York session to open. So anything greater than 40 kind of like puts me on the sidelines, either expecting a real deep optimal trade entry back in the Asian range for London Open, or I just simply wait for the New York session, because it's much easier to trade that and let the smarter people figure out what London's doing. All right, so let's take a look at an example when average daily range doesn't matter, and how we can use that concept and maybe ferret out greater profit potential. Okay, folks, let's look at an example at how average daily range doesn't always equate to the actual higher low of the day. A lot of folks have a lot of preconceived expectations on, and I think they're a little aggressive and outside the spectrum of reality. If it was like this all the time, obviously it would be just everybody would be doing it. But if we are in sync with the higher time frame premise, okay, and we're expecting a bullish move, and I'll zoom in and show you the intraday version of the swing we're looking at and the intraday action, and then we'll actually zoom out and it'll show you why this takes place. And it just so happened today was an example of this very phenomenon taking place. The average daily range in here has been fulfilled today. That's why the indicator that you see in my videos and in this one as well has already turned blue. Okay, so that means the average daily range has been activated. The average daily range, okay, low, is overlapping with the Asian range low here. So we have the Asian range here. Okay, it's a little less than 30 pips. So let's take a look at that. And you'll see that we have 28 pips for the Asian range. Okay, nice healthy little Asian range, nothing you know, extrapolated or too large. 40 or less is, in my opinion, a good Asian range. We have a optimal trade entry in here, okay, that you could have utilized. Let's take a look at that. Okay, pull that up to the Asian range high. And we have perfect symmetry in here. Comes right down to the 79% retracement level and reacts, breaks short-term little swing highs in here. So now if you've missed this one, you could utilize the smaller market structure swings in here on the intraday. Again, this is a 5-minute chart. And utilizing that, one could arrive at a buy signal in here around the 160.30 level. Now, if you were looking to buy that and take first profit here based on optimal trade entry rules, and then looking to take profits up here on the average daily range, let's put this over so you may see it. The average daily range comes in today at 160.57. So if you're looking just to take profits up here and old highs, there's nothing wrong with that, but don't collapse the entire position because you're trading with the higher time frame direction. Okay, and we're going to look at that in a moment. But let's just watch what happens as market trades on throughout the day. Rallies up, gives you an opportunity to take profits here at the optimal trade entry swing. Price comes up, blows out these highs. Okay, so yeah, this would have been a very handsome opportunity to take profits. Okay, nice little intraday 20 pip scalp. But look what happens. Here's your average daily range here. Okay, so if you're taking profits with the expectation that this is probably going to be the high of the day, you miss out on all this. Okay, so when you're in sync with the higher time frame premise, okay, watch what sometimes can unfold. You have the range here, and what we're measuring here is the average daily range. The average daily range. When that breaks, you could sometimes see twice the average daily range. You can see how we have a little minor reaction here, and still it continues to move on higher. Okay, so now watch what also you can do with Fibonacci. If you have the average daily range here and it's broken and you still hold on to a position and it starts to tear and starts to run even further in your anticipated direction, if you use that average daily range high, pull your fib down to it, okay, you have the 200 extension in here. Look how that overlaps very handsomely right there. Okay, so that would be a very nice objective to take profits at. Okay, nothing wrong with that. Add to that also, if you use your expansion tool, okay, just go over here and grab your expansion. Do the same similar type thing, but we're going to use the low here. It would just reverse it for sell signals. We're going to pull the Fibonacci expansion tool up using the average daily range itself. Okay, and let's get this off here because it may not be bothering you, but man, is it bothering me. The 200 expansion right here, nailing the high of the day. Okay, so you can see how these concepts, they blend. They're rather generic. We have used them all, for years now on baby pips and my YouTube channel. These are concepts that are repeatable. They go on and on and on and on. But do not be hung up with simply expecting the average daily range to, you know, bracket the market. Okay, in other words, just because the average daily range suggests that price may stop here, it may pause like it does here. And I'm sure there's a lot of traders in here that took this and said, well, this is probably, it. We're hitting old resistance, and there you go. Now let's take a step back. Okay, and all I'm going to do is zoom out to a 15-minute chart. Okay, you can start seeing rather handsome price objectives. Okay, watch what happens here. We have this swing down to this swing here. We have the 162 extension up in this same general area here. So we have a lot of confluence to suggest there's possibly something else up there in terms of profit taking. If we look at the larger price swing here on this fractal, we have this range here, and look what happens. We have the 162 extension nailing the high again. So we have a confluence of a lot of factors looking at 161.15 as a likely upside objective, which is well beyond the average daily range high here that's expected. To simply using one tool by itself isn't enough, guys. You got to have a confluence of things suggesting that this may be in fact going higher, and you see that happening here. So let's go out even further and look at an hourly chart, and you can see how we had made a longer term swing low here, moved on higher, we consolidated, and look what we've formed in here. Okay, do you see the ascending triangle here? Ascending triangle. We have price bouncing up against that 160.50 level. Okay, at the same time, we expected the dollar to break below its support level. Okay, because we have a descending triangle here. So we have symmetry between the two markets. Okay, so we are looking for the 79.70 level or 79.50 level respectively on the dollar. So if we're expecting weakness on the dollar, it's going to translate into higher prices on the cable, and you see that unfold here. Okay, so when you're trading in direction of the higher time frame premise, don't be lulled into thinking that the average daily range is going to block the market from trading any further, because it will not. Okay, it's just one tool. Okay, it's one premise to build your trading idea on. Now, there's nothing wrong with taking profits at the average daily range, but again, this is the reason why we just scale some out, because we don't know if it's going to be halting at that price level or not. It could continue on. Obviously, today's being a perfect example of that. So go over your charts and look at when the average daily range was broken and was not able to hold price back, and I think you'll be pleasantly surprised that it's always in the sense that you're trading with that higher time frame premise. I just hope it's been a blessing to you, and sincerely, absolutely wish you good luck and good trading.